The most recent tax act that avoided the fiscal cliff for the first time in a while raised the individual rates higher than the corporate rates. And the knee-jerk reaction of a lot of subchapter S corporations is, now that the rate differential is against them, we should terminate our S election. The problem is there's a lot of reasons you should be an S Corp, and you should retain your status or elect S Corp status. First of all, S Corps can use the cash basis of accounting. C Corps have limited, basis to use the cash basis of accounting. So that's a benefit for a lot of service companies, because you're typically doing services, paying your employees, paying your expenses up front, and collecting your receivables on the back end. So you get a nice cash flow that you're not paying tax on income you haven't received yet. The second piece is avoiding double taxation. Each year, as an S corporation, you pay tax at the individual level, so it flows through to you. Now, as a C Corp, you pay tax at the corporate level. When that's distributed to you, you'd pay a tax of 20%, a dividend tax, plus 3.8% tax. So in the end, you wind up, with a significantly higher tax rate on the overall income. The biggest advantage is when you sell a business, and this comes up all the time. Most buyers today want to buy assets, they don't want to buy stock. If a buyer comes in and wants to buy your assets, if you're a regular corporation, you have a double tax. Let's say you had a company and goodwill, among other assets, is worth $5 million. So that's appreciation out there that you really just built up over the years. If you look at the C Corp column, you got the gain of $5 million. It's taxed at 35%. Again, we're using the highest rate. And you're left with cash to be distributed to the shareholders of $3,250,000. Now, the shareholder also pays tax on that distribution. And the net cash to the shareholders is approximately $2.5 million. If you go to the S Corp example, there's a dramatic difference. No corporate level tax. The shareholder pays tax at 20%, so they're left with $4 million. That's a difference of $1.5 million on, again, a $5 million asset. Just going over that example, it's very dramatic, but typically people don't think of that until they sell. So the key is the appreciation within the company is only subject to one level of tax. So you've got a couple of things, as we mentioned. You've got the cash versus accrual. You've got the double taxation each year. You don't get a step up in basis if you're a C Corp. Then you've got the home run on the sale of the business, and people don't focus on that enough, and it's very, very important, because giving that up is a big mistake.